What if there was a way to transfer wealth to your children or grandchildren every year while potentially reducing future estate taxes and keeping control over how those assets are ultimately used? That's exactly why some families use a strategy called a crummy trust. A crummy trust is a specialized irrevocable trust designed to allow contributions to qualify for the annual federal gift tax exclusion while still keeping assets inside a long-term trust structure. Here's how the entire process works. The grantor contributes cash, investments, or other assets to the trust. Each time a contribution is made, the beneficiaries receive a temporary right to withdraw that contribution, typically for 30 to 60 days. This temporary withdrawal right creates what the IRS considers a present interest in the gift, allowing the contribution to qualify for the annual gift tax exclusion under current federal tax rules. To preserve this tax treatment, beneficiaries must be notified of their withdrawal rights through what is commonly called a crummy notice. If the beneficiary chooses not to withdraw the funds during the allowed period, the withdrawal right lapses, and the assets remain in the trust under the terms established by the grantor. That simple process creates some powerful planning opportunities. One of the biggest benefits is estate tax reduction. Because assets transferred to the trust are generally removed from the grantor's taxable estate, a crummy trust can gradually move wealth to future generations while potentially reducing future estate tax exposure. Another major advantage is control. Although the assets are gifted, the trust can dictate when beneficiaries receive distributions and under what circumstances. This can be especially valuable when beneficiaries are young, financially inexperienced, or simply not prepared to manage significant assets outright. Asset protection is another reason families use these trusts. Because the trust owns the assets, they may receive protection from creditors, lawsuits, bankruptcy proceedings, and in some situations, divorce claims against beneficiaries. A crummy trust can also provide long-term investment growth opportunities. Assets can remain invested inside the trust for years, allowing wealth to potentially compound while remaining subject to the trust's distribution rules. But these benefits come with important trade-offs. The biggest drawback is complexity. Unlike a simple gift, a crummy trust requires ongoing administration. Every qualifying contribution generally requires a properly documented crummy notice. If notices are not provided or properly documented, the IRS could challenge whether the contribution qualifies for the annual gift tax exclusion. That can create unexpected tax consequences. Another major limitation to consider is that the trust is irrevocable. Once assets are transferred into the trust, the grantor generally cannot take them back. This makes careful planning essential before funding the trust. There are also costs to consider. Legal fees, trustee fees, tax preparation costs, accounting expenses, and ongoing administrative responsibilities can make a crummy trust significantly more expensive than simpler estate planning alternatives. And while beneficiaries rarely exercise their withdrawal rights in practice, the possibility still exists. A beneficiary could decide to withdraw assets during the allowed window, potentially disrupting the grantor's long-term planning objectives. Some trusts also incorporate what is known as a 5 and 5 power, which may allow beneficiaries to withdraw the greater of $5,000 or 5% of trust assets each year under specific circumstances. These provisions require careful drafting because they can affect tax treatment and trust administration. So is a crummy trust right for everyone? However, it is not necessarily the right choice for every family. For smaller estates, the complexity and ongoing costs may outweigh the benefits. But for families focused on long-term wealth transfer, estate tax reduction, asset protection, and maintaining control over inherited assets, a crummy trust can be a highly effective planning tool. Because successful estate planning isn't just about transferring wealth. It's about transferring wealth efficiently, protecting it along the way, and making sure it serves the people you care about long after you're gone.